Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
G'day, mate. Welcome back.
G'day, mate. Thanks for having me.
Yeah, it's always a bit of fun. Middle of reporting season. I would say that this is the second busiest day, Thursday, the 26th of August. Yesterday was really busy for us. How about you? How's life?
Oh, that's good. I was going to say that, if you're in the small cap space, then most of the small caps report in the last week of August, right?
Yeah.
So it just, life is tough,
Yeah.
but life is exciting as well at the same time, right? I was looking at some of the stocks that I used to follow closely and that I've recommended in past life. And, I was happy to see some of them pop, some of them not pop. This was a pretty interesting day.
Yeah. It's always a bit of fun. It's been a few late nights this week. Did you ever have to, work back pretty late when you covered small caps?
I have this thing about stocks. I think, I never felt that I needed to have the compulsion to finish these stocks update the day they reported. And sort of, I justified it as follows. Maybe this is not a proper justification, but here's my justification. My justification is for long-term investors. Does it really matter whether, the update comes out now in 1 day, 2 days, or 3 days, but I'd like to digest the results. The only exception, so I look at almost everything. I've always looked at everything, do a cursory glance, and it looks great, looks good, doesn't look good, it's like a meh. And if there's a big, huge red flag, this is like something that moves to a hold or a sell, then yes, that, sort of that, almost the bad news used to percolate to the top of, okay, this needs to be actioned first. So that's how I had dealt with. Some days, of course, it used to be, sometimes you have the urge like, okay, there are 5 and I've gone through like 3. Okay, fine, I'm going to slog it out and do the other 2. And it's fun sometimes to get them out of the way because, as you said, you have 5 one day, 5 the next day. So if you have 2 left, you've got like 7 now to go over. So, but yeah, like I've tried not to do it that way.
Yeah. I don't think I've, I don't act necessarily immediately after results. I've never been one to do that, good or bad. But I will say that obviously when you do this for a living, you kind of feel the responsibility because your members or your investors don't always know everything as well as you do. Like we can look at a report pretty quickly, I would assume, and we can make a decision. Oh, okay, it's not that bad. Or, okay, looks good. I can move on to the other one that seems a bit dicey. And you can make that call really quick. So yeah, we try and get back to people, like to our members as quickly as we can. But hey, before we get into today, how can people find you on Twitter?
Well, they can find you at Owen Rask and they can find me at 7A Mahanti. That's on Twitter. Yep. Yeah. And come and chat with us is what I say.
Yeah. I'd say since we started, the engagement is going up on Twitter. I think it's been really good. Folks from everywhere coming out with ideas, probably too many for us to cover in one day. So what we've got in store for you today is we're going to talk about what Anirban's been working on, what I've been working on, and then we're going to go through, I think we've got 8 companies, and we're going to fly through them really quickly and I don't know, maybe have a bit of fun with them as we go. So some companies that you can put on your watch list. So to kick things off, mate, I actually, just before we jumped on, I was just reading a report. It's called, Is Zero Trust the Cybersecurity Framework for the 21st Century? Have any idea who wrote it?
Yeah, that's a good question. I wrote that one, and thanks for the plug. Yeah, so I had a lot of fun actually writing that report because there's a lot of different things there, and I try to simplify it and make it accessible so that people can sort of get the idea of what it actually means. So it's a report available on the 7investing.com. It's a free report. We call it a special free report or a free special report. Which all we ask that you give us your email address and we'll send you the report, a link to the report. It's free. Now, I have written it, but I would highly recommend people read it for a couple of reasons. Cybersecurity is a really, really important area. Every government in the world is putting money aside for investing in cybersecurity. Companies are investing money in cybersecurity, and Zero Trust, which basically is a framework for cybersecurity, management, which basically says that you don't trust anything. Which is kind of, if you don't trust anything, how do you actually give people access to devices and how they have access to services and so on? That becomes a tricky question. But there are many components of this of Zero Trust, and I try to highlight what are some of the main reasons you need Zero Trust, why Zero Trust is useful. There are multiple ways to implement Zero Trust, and what are the companies, most important for investors, what are the companies participating in this sort of, it's a range of ideas that you need to deploy to actually make Zero Trust work. So let me give some couple of examples. There are lots of companies mentioned in the report. One of the things I'll point out, which I think is really interesting, is you'd see that many companies collaborate with each other, right? So, and that's because they work at different levels of the Zero Trust stack. Mm-hmm. Right. So lower down the stack, somebody might collaborate with somebody up down the stack. And then there are three stock ideas for your, three stocks that we think you could buy to, I guess, get exposure to this area. So have a look at those. And all the three companies are, pretty big, large, well-known companies in that area.
I think it's really important for a multitude of reasons. And there are many more companies than just the three that you mentioned. But did you do the graphics? Because the graphics are great. They make such a complicated thing seem so easy.
Yes. So if you read this report, you might discover whether I'm a good artist or not. I did some of the graphics. I pinched some of the graphics from elsewhere, but I actually drew some of them on my iPad using, if you're watching this, using my Apple Pencil.
I need to get a pencil.
Yeah. So, I mean, it was a bit of fun to, sort of try to, and the reason I drew it is sort of conceptualize. Sometimes it's really easy. It's better to actually draw something and then say, okay, this is what I really mean. And, this is how it really works. And if you can draw it and explain it through a picture is worth 1,000 words. So that's what I was going for. So yeah, if you want to see how bad or okay my drawings are, then this is the report you want to get.
I like it. I think just on that, I think a lot of analysts struggle to use that side of their brain. And I think if you can use that side of your brain, it just unlocks so much in terms of your, clarity of thought and also your thesis and just the way you think generally. Having the ability to draw or just even sketch, even if it's only for you, just have the idea down somewhere. And so you can get that on paper or digital paper in this case. So valuable. I find myself doing it all the time because we do a lot of animated videos and educational stuff. I also go back and think this paragraph could just be an image, and I just go and draw it. And it's just so much easier and better for people that are trying to learn. So yeah, great report. I'll put a link in the show notes. We'll actually promote that at the end. So make sure you check out the report. Simple email, and it's yours. So mate, you got a recommendation coming up. It's obviously the 26th of August, as I said. So not long now until you got to drop another one.
Yeah, well, that's the fun you and I have, right? Our job requires us to give stock reports. Actually, I'm quite excited about the one that's coming out 1st of September. It'll also be a first for me in terms of how this one is going to work out. There's something there's some quirky about this one. I've never really tried this quirkiness, but I'm confident about the company too. So I'll tell you about the quirkiness later.
Okay.
Because if I tell you about the quirkiness, or I'll tell people about the quirkiness, then it might reveal the rec. But it's an interesting rec with a bit of a quirkiness to it this time.
Okay, interesting. Bit of a teaser there. There we go. Cool. Yeah. What have I done the last?
Tell me what you're doing.
I feel like the last week has been a blur, mate. We do these podcasts every week. We actually, at Rask, we now produce 4 podcast episodes a week. And I've also been going live a few times lately, which have been a bit of fun. So for our members, I did one just before we jumped on air for our Rask Invest members, and then I do one tonight for our ETF members, which is great fun because you get to answer a lot of questions and you get a lot of the same questions. So as an investment advisor, it's always good just to, if everyone's tuned in, just reveal the answer so everyone can hear it and say it once, and then you can always refer back to it. I find that's just from efficiency point of view, it's amazing. And our members love it because they get to speak to you, which is obviously great. But we've had, I would say in the last week, at least a dozen reports, maybe more, for official recommendations. And then we've got companies that are on our watch list, which are in contention to be recommendations. And unfortunately, there's 4 of us in our team, 4 analysts in our team. And I'm fortunate the guys work harder than I do. So there have been a few late nights, but we've all kind of worn that. And yeah, I mean, there's been some really interesting results. A couple of them we're about to talk to. So that's about it for me. Just busy and trying to manage through lockdown, trying to stay fit and healthy, which is always a good thing. My Apple Watch is definitely helping. We're actually doing a giveaway on another podcast where during lockdown, if you do the 10 personal finance things that we recommend you do, like the biggest items that are easiest to do during lockdown, you go in the draw and you just send us a message to say you've done it. You go in the draw to win an Apple Watch. So we've had heaps of people.
Now I really love this one. I should compete for this one. I need an Apple Watch on both sides.
You do twice the steps, right? It counts.
Exactly.
Yeah. So
I was going to say something. I think this is really special that you guys actually cover your watch list ideas. That is actually pretty special because, it's not an official recommendation, right? If it's on a watch list, like it could become a recommendation. But I think people then get, one of the biggest things I think you can get out of that is you can see an analyst, assuming the same analyst is covering or a group of analysts is covering it, then those people can over time actually see how the thinking is changing. And that's actually very good education.
Yeah, it is. It is. And it also helps the analysts too, because it gives them, I think you guys do this exceptionally well. And this is where I kind of got the idea from, to be honest. Having the advisors and analysts come up with an idea a month or tasking them with one idea a month is actually I find that's a really good deadline. I think that's just like a natural kind of feel. I said to the team a few months ago, I said, if there's 4 of us and we're doing, 4 ASX stocks a month between the 4 of us, one each, that's 48 that we're going to cover in a year. To be honest, there aren't that many really impressive companies in Australia on the ASX anyway, at least in terms of our niche. And so I said, I'd rather us really know 48 companies than us try and go through 100 or 200 and do a half-baked job. So, and to your point, what you also see is if you're researching Nanosonics and you've got the razor and blade model and you think, oh, this is great business, blah, 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 blah. Then you come up to, I don't know, Fisher and Paykel. You already understand the hospital environment and what, you can relate to that. And that's kind of where I think Charlie Munger talks about like a lattice work of mental models. This is, as investors, we're kind of trying to apply that. We have this kind of, this lattice work where we branch across to another thing and it binds it all together and it makes it stronger. And I think, so I think in summary, you guys do that really well. And that's what we try and do is just bring research out. That's what we're doing every day anyway. So we may as well write about it. Yeah, we're not sell-side analysts. We're still high conviction, but yeah, interesting stuff. Okay. So, mate, before we jumped on, we just had a bit of we've got a Google Doc here and we're just having a bit of a chat. What we thought we might do is we'll talk about 8 companies. We'll go one at a time. Companies that we find interesting for a watch list. We're going to give you the 30,000 foot view. Then we're going to talk about the headline numbers, try and focus on one key takeaway or metric or something. And then we'll give it a preliminary score. We're doing air quotes, preliminary score. So this is just based on the report. This is not a recommendation. It's just, what do we think of the report generally? And hopefully you can put these on your watch list. Join us on Twitter if you want to have a chat about them, if we missed anything in particular. So, mate, you've actually got an ASX company to start with. So I'll just throw it over to you. Feel free to share your screen if that's what you want to do. This is a company that I don't know much about, but I really like the idea of it. So Interested to see what you
Okay,
say.
so the company I want to talk about is Nitro Software. Code is NTO on the ASX. And, this is a very simple company to explain. So basically, if anybody's used, an Adobe document where you have signed, maybe you've done real estate via Adobe or DocuSign. This is basically the same sort of thing. This is basically a PDF writer, PDF editor, PDF signature repository, and so on. So it's a competitor to those guys. What is I think interesting is I think they're competing on price, and they're winning some here. What is another thing that's interesting about this company is 68%. This is a pretty big number of Fortune 500 companies are Nitro customers. This is a pretty big deal.
How many? 60?
68%.
Wow. I would not have thought that.
Yeah, this is pretty phenomenal, actually. And they're available in 155 countries. So, now when you think, about 68%, and then you look at the annual recurring revenue, it's actually pretty small. So they only reported half-year numbers because they reported half year 2021. They ended the half year with about $34 million of annual recurring revenue. So this, as I said, they're basically competing on price. So again, the thing to remember is that Adobe and DocuSign sort of lead the charts, and they have a whole suite of products. But then there are a whole range of other sort of PDF signature, PDF editing software companies out there. Nitro is one of them. But these guys are growing pretty quickly. ARR, or annual recurring revenue, grew 56% year over year. It's nearly break even on an operating EBITDA basis. Subscription revenue, and they used to be an annual, annual license maintenance type of deal. They've gone to a subscription model. Subscription now accounts for most of their revenue, but subscriptions are also growing at a much faster pace of 66%. So technically the TAM here is big, but there are two big fish in the pond, and you got to fight with them. But it's growing quickly. It's nearly break even. It's roughly at about, my rough calculation says it's about a 15x annual recurring revenue multiple. I wouldn't say this is cheap, but I wouldn't say this is super expensive. The question really is how long and how far can they keep growing? How much can they expand their product suite? It definitely is one of the companies that I would keep an eye on the ASX in terms of just the ARR scale, the growth, and it matches with many of the other companies that exist and list on the ASX. And I think the valuation might be okay. It's not cheap, but again, as I said, it's not very expensive. That's my take on Nitro. Okay, you want me to give it a grade?
Well, I'll give it a grade, but 1 second. They actually signed Blue Origin as a new customer. This is fascinating. We don't have to answer this now. Maybe this is for another episode, but wonder why these big companies choose Nitro when they could go with DocuSign.
So again, yeah. So I think it's just so they have been displacing some of the bigger guys, and they've got integrations with the Box and SharePoint and Salesforce and things like that. They've got some big customers that they've won. So they've got, as you said, Blue Origin, BNY Mellon. They've got Continental, Thermo Fisher Scientific. They've got some big names. And they're displacing in some cases the income. So I think it's price really. And often what happens is, in typically my experience with other software, I've tried out many of these PDF things. The software is just not as good as say DocuSign, or just doesn't have the full suite of offering from DocuSign or Adobe. That has been the thing. And Adobe has other things, right? We think of Adobe as, it's not just a signature company, right? So Adobe has marketing, Adobe has got, Photoshop and a lot of other things, right? DocuSign does contract management, for example, right? So if you were signing contracts, you want to manage, sort of the life cycle of the contracts and things like that, you can use DocuSign. So there's more to it. But yeah, competing on price and features is one of the things that this, and sometimes you win big fish. And I will caveat by saying, is Blue Origin really a big fish? When you look at SpaceX, probably not. No. Blue Origin is a small fish. But yeah, it's a good name to have for sure.
Was it a marquee client, right?
Marquee, but 68%, as you just rightly, you were like kind of a little stumped, right? 68% of Fortune 500 is a big deal, right? That's a pretty big deal. So I think this definitely deserves to be on an ASX tech investors watch list, is my point. it deserves your watch list attention. Then you can decide on valuation, TAM, and things like that. But I'm not making those calls. But I think it's a really interesting one to have, and it's break even on an EBITDA basis. Nearly, it's not yet, but kind of. So,
cool. I like it. So, and what score would you give the report?
I would give them. I'm going to be a hard taskmaster, and I'll give them a B+.
Nice. I like it. Okay. Next company is WiseTech. WiseTech, which is a polarizing company, and you'd probably notice that if you checked the share price yesterday. And yeah, I mean, it ended up 28%, but I think from memory it was up something like 40 or
54%. I was watching it at one point. I watch it only for one reason, that it had very heavy short interest, and I'm not really in love with shorts.
Yeah. So this is the company that you may remember. It was the target of a few short sellers who effectively said that you don't know the true picture of what's going on with its acquisitions and how much value those create. And because of, I think it was like cross-border auditing or consolidation of something. So basically made it hard to audit. And anyway, the business does software for logistics companies. So if you have a company that's shipping a MacBook from the UK to Australia and it goes through customs, it goes through everything, chances are that might pass through or be registered through a piece of WiseTech software known as CargoWise One, and they charge effectively a subscription, and they benefit from any rise in usage. So I'm just going to try and share my screen here if I can. Here we go. So I've got my slides up in front of me, and the one thing that I'm going to point out from WiseTech is actually one of the things you can see revenue from CargoWise was up 26%, overall revenue up 18, EBITDA up 63% to 126 million. Underlying results, so statutory NPAT down 33%. So interesting numbers all around. And what should I say? $507 million total revenue gives you a sense of the size of the company. But my favorite chart from WiseTech is all the way down the bottom. It's actually on slide 31 of 43, and it actually just shows customer cohort, or it basically shows a few things in one. But basically, it's cohort analysis, and it shows that over time, customers using CargoWise One make more use of it and they spend more. And this makes sense because more people are sending things around the world, and because of the pricing model, they tend to just incrementally ramp up revenue. You've talked a fair bit in the past, mate, about dollar-based net retention and the like. Yeah, so WiseTech says it has less than 1% attrition. So very compelling stuff there. I will just call out one more thing further up, which was the new customers that they sign. They tend to show this chart all the time. So these are like global marquee freight forwarders. And the one that they signed post June 30th was FedEx. So a big coup for the business. And all in all, I think it was a pretty good report. I need to do a bit more digging into it, but from what I can see, I would say B+. Taskmaster as well over here. I think it was a reasonable result. I think the reason that it jumped, there wasn't a 54% increase worthy result, but yeah, I think that's just because the shorts got squeezed, and it was a good result, all things considered. It just probably wasn't that good. So that's WiseTech. Still found a run by a guy named Richard White, who I believe was a roadie before he started the company. Could be wrong. I think that's what Koshi told me.
Or was he a drummer or something like that?
Yeah, he was something in music, and he would go around and manage all the equipment and things like that. So really interesting. Yeah, that's WiseTech, WTC.
I was going to say that, one of the things we need to remember with WiseTech is that their compare probably was easier versus last year. So they probably got the pandemic compare that they were doing, right? So, and they had some transport issues around, like, there was logistics issues last time, which they have basically lapped. But yeah, I think short burn was sort of why I had to tweet about it as soon as I saw that. Okay, this is not going to be nice for short. Yeah, but I like the fact that they have 1% or customer attrition. Just that's very, very good, right? And the dollar-based net retention, though they don't show it, should be high. And signing marquee customers. And then the final thing I'll say is 500 million in revenue.
Yeah.
That's not a joke, right? For a largely software company, that's pretty big, right? That's actually that's global scale revenue, growing still pretty quickly. So yeah, another one to definitely have on your watch list.
Yeah, just
All
to
right.
quickly, just so you know, the price to sales ratio, if you follow that metric at all, just as a rule of thumb, jumped from 24 to 32 in one day. So yeah,
Well,
32 times trailing.
Well, global scale, global multiple. That's what you get.
Easy, makes sense.
Easy, it just makes sense. There we go. So put it on your watch list.
Yep.
Okay, the next one we have on the list is a company called Snowflake, listed on New York Stock Exchange. This is basically, or the code is SNOW, Snow. How lucky are they to have that code? This company is basically what I'd call a data warehouse, data analytics company. So basically you house all your data in the cloud with them, and then you run analysis on via their software. And you could, they allow multi-cloud arrangement in terms of where actually your data lives. So they can pull data from any of the big cloud providers. This company reported fantastic earnings. So they reported, let me tell you the numbers. Okay, so revenue growth was 103%. Okay, and this is 103% over how much? This was over 104% to 272 million in one quarter, right? So this is a company that is basically on a run rate of close to now, billion plus dollars, that is growing at 100%. This is pretty insane.
Wow.
Net revenue retention, we have talked about this. So this is basically how much of the revenue from last year from your existing customers, that customers that have stayed on with you, how much has that grown? That was 169%. So customers that you retained are spending 69% more on you. That's largely because this is a usage-based model. So the more you use, the more you pay. It's not a fixed SaaS type of model. They've got the who's who of clients, from BlackRock to Accenture to Wipro to Tata Motors to Deloitte. They basically got everyone using their things. Tableau, sorry, those are not the customers. Those are the ecosystems. Pardon me, but they've got lots of customers. And gross margin about 174%. They had about 100 plus customers with more than $1 million plus in product revenue. That is pretty stunning. A big, large market opportunity, close to about $90 billion. So, they just scratched the surface. But just as, if 30 times sales makes you worried, this is probably even more. This is probably what, 60 times sales. I'll disclose for full disclosure, I do own shares of Snowflake at that huge multiple. I think this is a very special company, which is why I own it. But yes, I am always cognizant of that multiple, which means that can bring a lot of volatility. What did I think of the results? I think the results were really excellent. This is growth at scale. I'd give them an A on the results. I'm not giving, remember the A on the results is not A on the valuation. So they get an A on the results, and maybe they get it like a C on the valuation, and then overall it's still something like a B plus or something like that. But if you want to think about it that way. But yeah, I do own some shares of this company in our super.
Yeah, cool. I find it a fascinating business because it didn't, as you said, it only IPO'd recently. Can I just ask a question there? So why would someone choose Snowflake over just going with AWS or GCP or Azure or whatever?
So first of all, so one of the big things here, so they're platform neutral, right? So so one of the things about data is that if you're a company and you have your data is basically going to be siloed across multiple vendors, right?
Yeah.
And depending upon what application you're running, you might have a different cloud infrastructure provider that you're using, right? So how do you pull everything together is one of the big questions, right? And usually the AWS might not play nice with Azure as an example. It just might make it. So you have to pull the data in, and then you have to do the analytics on them. So that's basically their secret sauce in many ways, is to how do you do world-class fast analytics on pulling data from all the different multitude of sources and enable you to just make sense out of it. So it's basically data warehousing. And, so basically data is being ingested and then, into their system, and then you're using that for analysis. And I guess the biggest moat then is that they're ingesting data from multiple sources. So they're becoming the data repository for companies. And once you become the data repository of a company, you're unlikely to change that data repository.
I also heard that one of the big, sorry, I just dropped my mouse. I've also heard that one of the big benefits is that it's easier to use for different types of data sets. So because it's a data lake effectively.
Yes. Yeah.
So chuck anything in.
Yeah, it's a check. I'll be. What I'll say is that so you could. There's a structured data, there's unstructured data, the various types of data that you can analyze. A lot of companies do that to various extents. The question really is what's the breadth and depth of what you're doing, right? And I think they have got the most breadth and depth in terms of, and that's basically showing the usage that they're generating and the revenues that they're generating, right? So basically one way to, see how good they are is basically just looking at their growth rates and saying, okay, people really love using what these guys are offering. And the more people are using it, this is becoming better, right? Because they're now, you can almost look at the use cases people are using to decide, what you need to, sort of zone in on.
Yeah, it's a really interesting business, really, really interesting. So Snow, S-N-O-W. My company, the next one, which we both know, is salesforce.com, ticker code CRM. It's a really interesting business because we talked about this I think it was a month or so ago. We talked about how Okta, which is a company I own, and you may own too. Do you own Okta shares?
Uh-huh.
Yep. Okta, we talked about how Okta kind of didn't spin out, but has its roots in Salesforce. And so Salesforce is basically, it's a multi-cloud product business. So basically the way to think about it is that they sponsored the tennis this year, and they kind of do everything if you want to focus on your customer. So much so that they call their new ecosystem, I believe it's 360. And so where have I got it? I just don't want to butcher the name. Yeah, Customer 360. And so basically this is like your one source of truth. And what it does is effectively you can take in email marketing, you can build, your sales team can use it. We're going to talk about another sales enablement company in just a second. You can bring data in, you can automatically ping your clients if you've got a new product release, you can build websites, you can build apps. Basically everything that you would want to do in an e-commerce environment, Salesforce can do for you. Most people know Salesforce for its CRM. There's like Salesforce CRM, which is why the ticker code is CRM. But it's actually expanded well beyond that. And most recently, it made the acquisition of Slack, which you may hear ping in the background if I haven't turned it off. Slack is an instant messaging service that they paid in Australian dollars about 37 billion, which is their biggest acquisition to date. But they also own products like Tableau, MuleSoft, and a few others that you would know if you do anything in like an enterprise environment. What I thought was really interesting in the call today was just how fast the platform business has grown, 24% from 1.5 billion to 1.9 billion in 1 quarter of revenue, which is crazy to think the scale of this business and how fast it's still growing. All of the businesses lines are growing. And I think based on, I went back and looked at Slack's most recent quarter that we had publicly available, and it was well on track for $1 billion of revenue as well. So I think Benioff on the call this morning said that he's got 5 unicorns in his stable, basically. And I think it's a pretty apt way to describe it. Pardon me. I had some reservations about the Slack acquisition to begin with, because it seemed like a very expensive multiple, but I guess if there was a company to unlock Slack, it would probably be Salesforce. And they talked about that on the call this morning, which, to be honest, there was a lot of pats on the back. I think the analysts were kind of serving softballs to management, and management was serving softballs back to the analysts. And it was a bit of a, everyone patting on the back, and which I didn't love. But at the same time, they described how, for example, the due diligence for the Slack acquisition was actually done inside Slack. So, it's an example of how sales and all different types of businesses around the world can now use Slack. I think a really good thing too is there's a new feature inside Slack where you can invite people into your community. So say, for example, if you had a sales prospect, you invite them into Slack, and then you can use data inside the Salesforce ecosystem and anything basically inside the Salesforce ecosystem to automatically ping them and send them communications and things like that. And you can do the same for your team. So it's highly complementary. Business is growing fast, upped its guidance. I would say I'm going to give it an A. The report, I'm going to give it an A. It's about 11 times trailing revenue, the shares, but I'd give it an A. I wouldn't give it an A plus just because of all the pats on the back. It kind of annoyed me. But that's Salesforce. CRM is the ticker code.
I was going to say, one of the things I find very annoying is this use of 360, Microsoft 360.
That's why I got confused. I didn't know whether it was one or 360. They're all the.
I just hate you. Can you not come up with a new term, please? So, fantastic. Yeah. I actually really like Benioff as a leader, and I think they're doing a great job. Great. Okay, so somebody got an A from you. This is pretty impressive. What do we have next? We have. I am looking at the list.
FineOS.
FineOS. Yes, I like this company. I think this is another very interesting niche company. So FineOS basically provides software and underlying tech for basically insurance. Okay, so they service life insurance, accident insurance, and those sort of things. Basically they're like the operating system for those sort of things. This is a European, I believe this is an Irish company, if I'm remembering this correctly, because they report in euros. And they've got, a pretty good, they make acquisitions and things like that. So bolt-on acquisitions happen. But, this is growing relatively quickly. So the revenue they reported for a full year was about $108 million. That was up 23%. The thing to remember here, though, is that because of the type of industry that they operate in, and there's a lot of integration. This is not like a plug and play, right? It's not like getting CRM and that, it kind of works on the cloud and stuff like that. There's software and then there's services revenue for it. And their services revenue is a bigger chunk, about 60% of the total revenue. But software revenue is growing really quickly. Again, remember that the reporting is all in euros. So this is a fair bit of revenue, but software revenue was about 42 million euro, up about 42%. Services revenue was only up 14% to 66. Decent gross margins, considering the fact that they're probably not making that much money on the service that they would like to make on software. So it's got very good retention numbers when they report. I haven't seen it this time. I think this is interesting because, again, sometimes when you have software that's niche focused and you kind of dominate, they get 73% of the revenue from North America. APAC is 22%. So they've got some opportunities. And what's very interesting is that they're a European company with mostly North American revenue. So again, this is one that I would put on your watch list to check it out.
I always thought, why did it list in Australia? Or did it start in Australia?
No, so this is not no. So I think a couple of reasons for this. One is, where would you list, right, at that kind of revenue? Your options would be either to list in the London's AIM market, right? Because the revenue is small. You wouldn't be able to list on NASDAQ, right? You could be listed in OTC or something like this. So I think Australia was a natural place maybe for them to list. I mean, I don't know, but is there a stock market in Dublin? I'm not really sure. And maybe that doesn't have, again, what we should remember is we're the fourth largest pension pool, right? And there is a demand for tech type of stocks. And this fits the bill as a tech stock, right? So yeah, I don't think this is what I would say is that this is for what, I think in terms of quality, this is a quality company for what it does. It's not super high growth, but it's in a niche area where it is, doing really, really well, right? So again, this ultimately comes down. This was really up, I think, on announcements. So people probably were not expecting this kind of growth. They were expecting probably less. I think historically has done a little less. But again, only thing to think about is what the valuation is, and you have to be careful with the valuation here because it's got a services business, and the services business will have lots of ups and downs.
I saw a comment. I just did some digging. I found a comment that said, "We're looking at Asian markets now, and that is one of the key reasons for doing an IPO in Australia." There you go. And they also had ComInsure, TAL, and Westpac as clients. So this was from an AFR article in 2019. Interesting. So what would you give the report?
I think the report was really good. I'd give them a B+ for the report. I mean, yeah, it was a good report.
Okay.
I could even give them an A for. I mean, the reason I'd give them a higher grade is basically, my growth expectations are based on sort of the market and the opportunity, right? The market is a certain size, is a niche market, a smaller market. I don't expect 50% growth here. So I think for what is possible, because it takes a while, right? You want to sign TAL or ComInsure, that sales cycle is going to be a long one, right?
Yeah.
and then it's going to take a while for that revenue to feed into your system.
Fair enough. Okay, cool. I like it. So the company that I'm doing next is Afterpay, which I don't think many of our listeners would know.
Nobody knows about it.
APT is the ticker code here in Australia. Soon to be maybe SQ. I don't know if the deal with Square goes ahead, which we talked about at length in a previous podcast. So you can go back and listen to that one. Afterpay, as we know, is buy now, pay later, makes money from the merchants. What did it report? So I'll just come out and say, I reckon it was, I feel like the B+ is the middle of our bell curve. I'm just going to stick with that. So a B+ on the update. So they came out and said underlying sales up 102%. Don't be confused. Underlying sales is actually sales through the platform, not necessarily the revenue that the business earns. 16 million active customers, 100,000 active merchants. What's really interesting is that I think they added around about 6 million merchants. So I think I did the math. It's about not 6 million merchants, 6 million customers, which I think worked out to be about 15,000 a day. So which is really interesting when you think about that. I'll just make sure I'm doing the numbers correctly. Yes, 16,000 a day, which I remember looking at Afterpay like 3 or 4 years ago, and the number of customers that it was signing up. If you would have said to anyone, "Oh, we'll be signing up 16,438 customers on average every day in a few years," people would have probably gone, "Oh, that's. Are you all right? Is there something wrong?" And I think as investors and analysts, we can miss this if we look at just the percentages and we don't actually look at the numbers and see what it actually means. And so you get a sense of the scale of the business. So really, really, fast growing business. The net loss widened. Underlying sales in North America, which is obviously the key market, up 177%. That makes underlying sales in North America 11 billion of the total 20. So that they were aiming for. So overall, they got 21 overall. So really interesting growth in the US, and you can see why Square is buying it. I think Afterpay is going to be stronger with Square. I think Square is going to be stronger with Afterpay, frankly, as well. And so all pretty good. Probably the one blemish is a slight reduction in the margin that they earn, which may or may not be as a result of competition or discounting or what have you, maybe moving further down the quality spectrum in terms of their merchants. So Afterpay, there is some concern there around the margins, but growth is taking off. And if I was looking at it, I wanted to make sure it's still growing in the US, which it seems to be. But you probably won't need to worry about that soon because it's going to bolt onto Square and it's going to be a formidable beast. So B+ from me, and a really interesting business in Afterpay. That's that one.
Excellent. I love it. What do we have next? For me,
one of your old favorites. It's
a
roll up. It's a roll up.
It's the roll up that you don't like. The roll up that continues rolling. Okay, so this is Bigtincan. I'm not going to spend too much time talking about this because I've talked about this previously. But it's a sales enablement software. There's plenty of competition, but what is happening though is the competition is slowly disappearing because Bigtincan is putting all of that competition in its big tin can and locking the can. So this time they went and acquired a company called Brainshark. Actually, I remember when I was researching this company, this Brainshark was one of the competitors I was thinking about. I thought this was an interesting deal because, and I'm still a little puzzled because they're buying Brainshark, which has about an annual recurring revenue of about 46 million for only 2.5 times the multiple. So when that happens, I really, think, are you buying something that's good, or are you really buying a lemon? So I really, this is the first thing that came to my mind when I looked at it. But Brainshark had, Brainshark's customers, they've got some marquee names. Like they've got AstraZeneca, they've got CVS Health, they've got MetLife, they've got IBM, PepsiCo, and Zoom as their customers. Okay. So pretty big customer names. So I don't know what is happening there in terms of why is the multiple so low. My only guess would be that there's pretty much maybe less growth or no growth. And then I guess acquisition allows for cross-selling, maybe a bigger enterprise sales team and things like that. The other thing that happens because of this acquisition is that Bigtincan's combined, like the combination, they're not really calling it an acquisition, it's really a merger, they're saying. But the merged entity would have an annual recurring revenue of 119 or nearly 120 million Australian dollars, which is a pretty big number. And if that number is still growing at 30-40%, then 30% would mean, or 35% would mean doubling every 2 years. That's pretty formidable, and they're becoming sort of a big name then in that category of theirs. So I'm not talking about the results because I actually haven't looked at the results, but the market was super giddy about this acquisition and the stock was up big time. Because, I've talked about this before, that, ARR of like $100 million is sort of what you need to be. And, I really think of ARR in US dollars of 100 million. So this is 120, it's kind of getting there. So they are getting to that, we are big, but we can becoming big and scalable. And, we have got, so growth at scale potential. So the market is happy. How would I rate this acquisition? As I said, I have question marks. I just don't understand the 2.5, that sales multiple looks too cheap, too good to be true. Why would you do that and in that way? So that's the question mark I have in my mind. But again, Mark is happy.
Yeah, I don't necessarily expect you to know right now, but do you know who the sellers are? Like, is it private, or I don't?
I actually haven't looked at that.
Maybe it's someone trying to exit quick. Get out now.
Yeah, but I mean, whoever is the seller, right? I mean, if you've got a great business that's growing at a pretty reasonable rate, right? Even if it's private equity, right? Why would you, when the public market is offering multiples, like we just talked about Nitro, right? I mean, Nitro has a 15x multiple. Why would you sell at 3, 2.5, right? That is, in my opinion, something to think about. I don't know what the answer is, and I haven't dug enough, but when I saw that, I said, well, okay, that kind of puts a question mark in my mind. But something to, again, I think it's an interesting idea, interesting company. And, this is basically taking out an opposition. Let me rephrase this another way. It would be funny if, Afterpay was bought out for $10 billion. You don't buy out a great company for a cheap price. You have to actually pay premium to buy out a good to great company, right? So I think that's the doubt, right? I mean, I have, and I'll plant that in whoever wants to think about this.
Yeah, right. Okay. I can't really find, maybe there was something discussed on the call, but I'm just going over it now. I can't really find anything in terms of their recent growth, like in terms of
it doesn't anything. It basically says it says sustainable 46. So I am thinking that they were going backwards, or maybe they were flat, and maybe so I don't know what the rationale is. Maybe this is just customer acquisition, right? That at 2.5x, I'm getting the customers, I'm going to just put them all into Bigtincan's platform. It's maybe a cheap, if you think about the LTV that you can get out of this, maybe this works out if you can retain those customers. It's a dicey move, but if that's the case, it's a dicey move.
I'm just looking at some of the acquisitions that Bigtincan has made, and often the criticism of Bigtincan is, what have they acquired now? Well, they've gone big or gone home, because this acquisition is multiples bigger than all of them put together. So
that's Owen. Actually, that's a fantastic point, right? So this is something that people need to think about. Is this happens often in the small cap land, which is just called the quantitative easing based method to acquire companies, right? And you can keep acquiring, but then if the acquisition is driving your growth, then you need to make bigger and bigger and bigger and bigger acquisitions, and the potential of making mistakes becomes bigger and bigger and bigger, right? So yeah, maybe I'm slowly coming over to your side, Owen, here, in terms of thinking, but yeah.
It's that old thing, be there for a good time, not a long time. It's probably, yeah, it reminds me, yeah, I mean, roll-ups are everywhere. So what did you say the acquisition was in terms of like a report score or like an acquisition score?
The price was very cheap, so I don't know what to give. If I have to give them, if it's astute pricing, then they get in like an A++, right? But if they bought a dud, they will get like a D-. I really don't. Let's say the grading for this, the final grade for this is only going to be known in due course in the future.
Yeah. So okay, unknown.
Assignment incomplete.
Yeah. NA, you could just give a score to the student based on, I don't know, because they didn't give you much, so you've just got to score it. You've participation award for
yeah, participation award. Yeah, merit award. Let's call it a merit award.
Yeah, gets a merit award. Okay. The final company that we've got on our list today is one that, well, as far as I know, doesn't use a similar strategy. So this is Nanosonics. I'm going to try and jump across to that just now. I was actually just mistakenly about to open the customer service function from Rask Australia on Zendesk. We don't want to do that. Okay, so Nanosonics, for those who don't know, is a razor and blade model. That's how it's described. Here we go. And it basically creates think of it like a microwave that you might put your McCain pizza in, except this one's in a hospital and it disinfects ultrasound probes. And so full-year results, revenue up 3%. I think the catchphrase of reporting season August 2021, and I don't think I'm alone in suggesting this, might be a tale of two halves. The number of CFOs who said it was a tale of two halves, I think if I had $1 for that, I would probably be able to own the ASX. And so it was a tale of two halves for Nanosonics, because obviously the first half of their financial year was really, really constrained by COVID, not getting access to hospitals. The business makes money in two ways. It sells a Trophon unit, which is like a disinfectant unit. Think of it like an upright microwave that you put the probe in, and it's a better solution than in the past where they would just kind of, some hospitals still just wipe it off with like a disinfectant wipe. And it goes into the machine for a few minutes and then it comes out disinfected. Nanosonics makes money by selling the units, but also by getting consumables and maintenance revenue. And so the company reported free cash flow of $5.9 million, which was down substantially from last year, but up half over half. They actually expanded their total addressable market. So this is one of the companies, mate, that we actually covered as our watch list company. Raymond, analyst, did about a week and a bit ago. And we kind of concluded that the valuation was reasonable given the TAM, and we thought that they were mildly understating their TAM. And there are a few reasons why we didn't push ahead with it. And a few of the reasons were their R&D function. They've said for a few years that they're going to roll out products, but they haven't. And so if you're looking at the TAM and you're weighing up the numbers, you've kind of got to bank something in there, or bake something in there, I should say, to suggest that it was going to be market beating, I think. And they've increased their TAM, but they've also basically announced two products, which is Audit Pro, a software compliance function for hospitals to use to test where ultrasound probes have been or what they've been doing in the hospital, so you can really keep track of that through the cycle. And the other thing was for endoscopy, so flexible tubes that go in your body, being able to disinfect, being able to do things around that. So that product's still a few years away, but it was really interesting that in terms of development. They always said it was an adjacency, so we'll see how that goes. Global installed base up 13%, which is really interesting. The second half new installed base up 20% compared to the first half. And for those of you that are watching on YouTube right now, I'm actually just going to jump into the DCF that we've got and just the valuation model here, just in Google Sheets. So just the point that I'm going to call out, this is the top of the DCF. We're modeling here through the segments and then also through the number of units. One of the things that Nanosonics did in 2019, I believe it was, or 2018, 2019, is they actually do a lot of their sales through GE Healthcare. And in that time, GE would take some of the consumables revenue, but also some of the capital sales. And you can actually see in the period around then, so if I can just get my screen right here, 2018, 2019, you could actually see how the revenue mix had shifted and how, I guess, consumables revenue started to accelerate for the company. So we can see that here. And I'll actually just jump across to this one, which actually shows the updated model. And so here you can see that consumables revenue did start to jump, but then fell back in 2021. And the reason I think that this fell back is because COVID restricted the use of Trophon units. So consumables and servicing just wasn't as readily available, but also they weren't able to sell into new hospitals. So we saw that fall. People are concerned that the revenue per unit is falling, and that's a fair criticism. But when you consider the useful life of the systems, they actually make more money, or not more money, but they make a lot of money from the ongoing subscription, those blades in the razor and blade model. So don't be too concerned about this, would be my feedback. It's still growing. It's installed base. It's got new products now. We said maybe not right now to the shares, and then the shares jumped 25% in a single day or something like that. So maybe joke's on us, but Nanosonics, NAN, I would give the report, Raymond might have a better ability to score this, but I would say an A from Nanosonics. So upon reflection, mate, let's just go through them. Nitro Software, a B+ from you. WiseTech, a B+ from me. Snowflake, was that an A? I think it was an A.
Yeah, I said an A.
Yeah. Because we're not judging the investment merits, like a valuation. We're just saying about the report. Salesforce was an A from me. There's actually a very common theme here. Afterpay, B+ from me. FineOS, which is a really interesting business, from you was a B+. Bigtincan gets the unknown/NA/merit/participation award. So we don't know exactly how to score that, but merit sounds good. Big deal ahead. So if anyone's on Twitter and has an opinion on Bigtincan, let us know. And Nanosonics got an A. So I think that's a good list of companies. We should have a few more for people next week. If you like the structure of us having a bit of fun and giving a score, you can jump on Twitter and let us know. Mate, before I let you go, we should give this free report a special nudge as well. If you're interested in cybersecurity, you can get the report. It's 7investing.com/free-special-report. Very simple to remember, but we'll have it in the show notes if you want to get a copy of that and see old mate's pencil work. It's actually pretty good. It's pretty good.
It's a credit. Let's put the credit to Apple Pencil. Tim Cook. Tim Cook for the win.
We couldn't get through a podcast without bringing up Apple. So yeah, it's a great report. So definitely check it out.
Thank you.
And anyone, if they want to reach out, can say g'day on Twitter. Again.
Yes. Yeah. And we have not ignored your advice of various companies on the list. We have them for next week.
We do indeed.
There's only so and if you've got a few others that you want to add, please add. I'm going to probably talk about A2 milk because I like talking about milk. Just advance warning.
Takeover. Still waiting for that takeover.
Still waiting for that takeover to happen. But yeah, it's fun. It is fun for us this while it's stressful and stuff, but we kind of enjoy. It gives us better, and we're not that phased by, and this is maybe a lesson for people, right? Once you do this enough number of times, you've been through this enough number of times, you kind of don't get phased by it's plus 25. It feels good. Minus 25 it feels okay, and you kind of move on. And I know I'm not trying to make light of if you own a minus 25 and you feel bad about it. I know, but you kind of want to make the averages work for you, but that's kind of what it is. The market does its thing. If you make it a bit of a fun, then it's more enjoyable.
Yep. Down 11 or 12% at the time of recording right now. So
which one? A2?
A2. Yeah.
Yeah.
So my bet, I think, with you going back a month or two, was that Treasury Wines would get bought out first. Treasury Wine share prices go in the opposite direction for a buyout. God damn it.
Oh, has it gone up? So
it's ramping. It's up. In the last 6 months, it is up 13%, whereas A2 milk is, let me just get my calculation out.
It's down 20%?
Down 32%. So
it's getting closer to a buyout.
I feel like you're going to get some free milk soon. No.
I'm going to take some Penfold from you, mate, for that one. So if I win, I get Penfold, and if you win, you get milk.
Oh no!
Looks like a good deal to me.
I might, yeah. Well, I might. Well, yeah. The milk might be getting cheaper too on the shelves by the looks of it. So, yeah, fascinating. So, if you want to hear us talk about things next week, give us a shout out on Twitter. We are going to spend more time looking at individual companies. Today was just kind of rapid fire, just because of so many reports. So, just a bit of fun today. But yeah, mate, as always, how can people find you and read more about what you're doing?
Well, just come to Twitter or go to 7investing.com and subscribe.
Yep, simple. Cool.
Simple.
And if people want to hear more about Rask or catch up on any of the podcasts, rask.com.au. So that's rask.com.au. That's where you'll find our stuff. Mate,
beyond
as always.
and on, right?
Yes,
beyond and beyond.
Beyond. So Beyond was the space mission, and that's what we named our new small cap service. So it's a bit of fun. But Beyond is the name.
You need to get some. You need to get the Blue Origin guys with you guys. And you need to put the Beyond on one of the Blue Origin rockets.
That's
That'll
it.
be something.
If they put our logo on their, I wonder what it would cost. It would cost.
Well, first they have to get something to. They have to get. Blue Origin has to get something to fly. So maybe they have the privilege of actually putting the logo on. Maybe you can charge them, because what if it blows up, right?
Yeah, it'd probably be good for the publicity. I'm not sure how good it'll be for the whoever's on board, but.
Although I'm assuming nobody's on board. I'm not.
Yeah,
that
of
cruel.
course. Yeah. Well, we'll see. So, marquee client coming up. Blue Origin for Rask. Okay, here we go. I'll see what I can do. Cool, mate. As always, pleasure.
Yeah, pleasure. Pleasure all mine. Thank you.